you'll see. So you want to mark your high and then your low, right? But the main thing we're looking at here is a false breakout to come. You don't have to do anything at this point. You want to see support forming, which you'll see as I play it on. So a support level gets formed. Now many people who are using a box method will do something like this. They will draw the box around here and they will see the price is chopped around. It has reclaimed above the 50 and it's holding above that. That will be a signal for a lot of people to buy the next breakout. Okay, but it's not a signal. I see a lot of people using Professor Ayush's box method incorrectly. The box method is supposed to set up breakouts. It's not something you're supposed to anticipate by buying before. Now, I'm sure there are ways you can do that if you test it, but that's not how it's supposed to be used. So in this example, we are not looking for the first breakout to hold, so we do nothing here. We're not going to buy here because we're expecting a false breakout. So we do nothing, which makes it even easier because you have far more time to act and form your plans. Of course, it requires patience, but if you don't have patience, you're not going to make it in trading anyway. So, also of note is that there is support forming here. Once, twice, 3 times. So we seem to have a nice solid support down at this $14, $15 area. Again, we do nothing. A lot of people are now going to be buying because it's rising up, it's above the 50, it's looking strong. But the market's not that simple. And so it comes down again with a big flush. And for us, where everyone else gets liquidated and stopped out, we think, wow, really nice retest of support. That's just making that support even stronger. Again, because we are waiting for a false breakout. And so we wait for price to come up. And here it comes up now to the area, right? Remember, we are not buying the breakout. We're not going to buy the first breakout. We're going to wait. Because what you want to do in this scenario is to wait for price to come above and then back below and hold above the 50 ideally, but most importantly, hold above the 0.5. So the 0.5 is drawn from your high to whatever your lowest point was, which was over here. And you draw a simple range, 1, 0.5 and 0. And your 0.5 is your midpoint. That's where you don't want to see price going back below. But again, you don't have to do anything here. I'm going to show you what a strong false breakout looks like. A strong false breakout will go above the high and generally close above the high as well, because that's going to trigger a lot of people to enter breakouts. If it just wicks above and back below, that's more likely to be a legitimate false breakout and actually go lower. But this one, as you can see, it has several candle closes above, 1, 2, 3, and then a big wick above, and it falls back inside. At this point, you still do nothing. We get another couple of closes above it. You still do nothing here, because it could go all the way down to the 0.5 and still be valid. This 50 should hold, but in a volatile crypto market, we can easily get wicks down because it's going to go hunting for people's stops. So again, we do nothing. The time you want to buy, right? If you're saying that this is a strong false breakout, i.e. a false breakout, it's going to come back above your original line after coming back below it, or coming down below it, I should say, towards the 50. And you want to buy when it's rising back up. Okay? So you're going to wait for price to rise back up here. Here, or if you want to be more conservative, you could wait for it to clear all of that with these impulsive strong candles, and that is your time to buy. Of course, you don't want to be buying into this one. You do want to get in after it has shown that it is resistant to going lower. It's came back inside, so it's taken out anybody who just blindly buys the breakout. It tries to go lower, and then it rejects. It starts to push higher again, and then you enter. Now at this point, you've got 2 options. You can either put your stop loss aggressively directly below the 50, right? So wherever your breakout candle, your entry candle is, you can put your stop loss below the 50 period EMA. That's if you have aggressive stop. Or if you want to be more conservative, to put it below or right at the 0.5. Because if it's going to break and actually hold outside this box, this EMA trend line the trend, sorry, of the EMA should remain inflecting upwards. You cannot have an uptrend if the EMA is going down, right? It can briefly inflect downwards, but an uptrend has an upward sloping EMA, and you're trying to catch strong uptrends. So you want to have an EMA that's moving upwards. So in this case, if it went all the way down to the 0.5, it would definitely break that trend, and so you wouldn't want to be in that trade. Now, I'll show you, because this is a good example of how the aggressive stops can fail, which doesn't mean that the aggressive stop is a bad idea. It just means that you need to test this rigorously and understand the expected value of either using aggressive stops or conservative stops. And so you'll see on this one, we get that. Big scam wick all the way down would stop you out right below that 50. Okay? Now it's important not to just look at this one example and say, oh, well, I would just put my stop here and then I would never get stopped out. That's not true either. Because you can't take one instance, this is why you have to test it, on many different coins and many different time frames, many different setups to see what works for you. Okay? If you use the conservative stop, obviously you're totally fine. Price continues on, trends all the way up, and you have an excellent entry for a big trending move up to a new level. And the 50 EMA inflects upwards, trends strong, keeps going. So the principle there of the false breakout is that you're waiting for the first false breakout to fall back inside, ideally touches the 50 or comes close to the 50, spend some time below, should be more than just a wick. Sometimes it will just wick, but if it spends a little bit of time in there, in a trappy type of price action, it's even better. You can also go to your lower time frame and watch this forming, okay? It'll push once, twice, 3 times. This is stop hunting. So it takes these people out, takes these people out, then goes below and above and starts to break out from the 1 hour 50 EMA. You can use your fractal time frames to get your entry dialed in even closer if you want. But the main thing to remember is your first false breakout or your first breakout will fail. Okay, that's the assumption you're making. Won't happen every time. Sometimes there'll be clean breakouts and it won't come back. But your job is to find the false breakouts if you're using this system and identify whether it's a strong one or a weak one. So it comes back in, gets back above, and that's your signal to get in. Okay? So that's one example. And that's using a daily, this is actually a weekly uptrend with daily impulsive candles, and then a nice lengthy consolidation on the 4 hour where you don't have to do anything. Where most people get chopped up is in all of this shit, because it was trending up, trending up, trending up. They try and long this dip, and long that dip, and long this dip. And even though all those places are good to buy, most people get chopped up because they might buy this first dip, then it comes back down and they panic and close. They might buy this one, comes back down again. You don't want to do that. You want to wait for price to have a lengthy consolidation on whatever time frame it is you're using, so 4 hour for this example. And then after the breakout, when it comes back, you're looking to get on board as soon as it's showing strength, starting to push back up above that level for the next leg of the trend. Now, that's one using a 4 hour chart after a weekly or a daily. There's one here on Chainlink, which you'll see that is used on a daily breakout. Okay, so we have a strong daily breakout over here. And so Chainlink has a daily breakout. I think it also confirms a weekly. Yeah. And now you're seeing one where it doesn't offer a 4 hour setup. So this is why you want to watch your 1 hour chart initially, because you should be watching the 1 hour first. And if it's not building a tight consolidation on the 1 hour, you want to zoom out to your 4 hour. But at this point, you want to go to your 1 hour, get your EMA on, right? Allow price to come down. At this point, again, you would do nothing. This hasn't formed a box yet. This has not formed any kind of sideways consolidation. It has a high, it has a low, but you're doing nothing, okay? Let it play on. Now you'll notice on this one, the 1 hour chart on Chainlink is much less volatile. The 50 is moving smoothly. There's not wild swings up and down. So this one does have potential to be a 1 hour box or a 1 hour consolidation, right? Because if you go to the 4 hour, it's still well above. And if you're looking to get an entry, it's not going to come off a 4 hour box. For a 4 hour box to form, price would have to come down significantly. It hasn't. So Chainlink's showing very strong trend here. And again, you want to wait, and you want to wait for your false breakouts. Now, this chart shows a couple of really good valid false breakouts. So it chops up, it chops down. It's forming a nice sideways box here. Okay, so price is starting to go sideways. You see that it wicks above the high, but that's not something that we want to touch, because remember, it has to at least close or show some genuine strength above the high first before you want to be buying any retracement, any dip. So that's just a legitimate false breakout. You don't want to touch that. It's probably going to go back below the 50. We have another one, which again is just a false breakout. You don't want to do anything there. It goes below the 50. But all of this is forming a nice long 1 hour box. Okay, it's building along here. It's following your principles nicely. No need to go to the 4 hour yet, because the 1 hour 50 EMA is still nice and tight. It's not showing any wild swings, not showing any oscillations, wild variance in the deviations from the 50. And then you're waiting for a breakout that actually holds. So we see one here. There we go. Above this high, which was our new high that was set. It breaks out and closes on the 1 hour. Okay? This is now where you're waiting for the false breakout to happen. You've now got your box that's formed. It's consolidated at the top right corner. It's broken out, but you're waiting for it to come back inside. Because again, it's bull market. Chainlink's gone up strongly. Everyone's trying to buy every breakout. You're waiting for it to come back inside. Okay? Let's see here. Down it comes. Retests the 50 or down towards the 50. Again, you don't want to do anything here because it is still below the red line. Right? This could still be a valid false breakout. It could actually go down to the 50, down to the 0. As soon as it comes up and starts to show strength, like it did here, okay, it went below, retested, sold off, broke above here. Now that it's back above that level, it had closes above, dipped back inside, stayed above the 50, up to here. That's where you want to enter. Again, aggressive stop would be at this point here, which is below the 50. Conservative stop, below the 50 EMA. Conservative stop below the half midpoint of your range. And you'll see that these are much more likely to actually be the breakout because people have gotten wrecked in between, and away the trend goes. That's your initial entry for Chainlink. And it goes up and up and up. And that's how you avoid all the shit, right? You avoid all the chop, you avoid all the mess. You don't take these false breakouts on wicks. You wait for an actual breakout, understand that it's probably going to have a throwback, which means it's going to pull back into that level. It's going to chop people up and fake people out inside it. You don't touch it there. As soon as it starts to break out of that again, that's when it's likely to be an actual breakout. You get in, you set your stops, and away it goes. So there's one that does, if you use the aggressive stop there, you would be fine. And you would actually have a really tight entry. And obviously, a positive, high risk reward trade. Now, the one on AGIX, which I just showed at the start of the stream, is a good example again of one of these pullbacks. And this one actually, you could trade it on one of the other methods I mentioned, but this is quite good too. So if you're looking at AGIX here, it's had a really strong daily trend off the lows. It's broken above the previous consolidation level. The 50 EMA is trending up strongly. So AGIX is in a nice strong uptrend as we're moving here. Okay, go to your 4 hour. You wait for it to start forming some kind of a consolidation that would form like a box. And so it goes down, it goes up, it goes sideways. And this one sets up several, well no, two I think it is, false breakouts in between. There's one. Again, you wouldn't touch this because it's just a wick. No closes above, but now you're waiting. Do we get any closes above? There we get one. So we actually had, sorry, there was one before that. We actually had one over here. Well, there was a candle close, comes back down. Yeah, let me reverse this actually slightly, just to show it in more detail. The first false breakout, right? Up here. Because you might say this is above the 50, this is looking strong, breaks out, closes above, but when it closes above, that's not your trigger. It has to come back inside, which it does, and then your job is to buy when it shows strength again. Does it show strength by closing above the red line? No, it goes lower. See, no candle closes, no signal for you to get an entry, right? So you allow it to play out, allow it to form, starts to come back up. Now you can draw your high to low, wherever your highest point is, to your lowest point. Continue it on. You get another false breakout, so you draw your line across there. Another false breakout. That one's just a wick. And away it goes. So this one breaks out, big impulse. Looks like you've lost it, right? Looks like, oh, I've missed the breakout. No, very, very unlikely. Because we're in bullish market, because the market is now only looking one way, which is up, it's still very, very likely the price comes back to retest those levels. So you're looking at the same thing. You want to see price come below the red line, right? That's what you're looking at. I'll take this one off. You want to see price come below it. And as soon as it comes below it, you then want to be looking at your entry. So it comes below on this wick here. And then you want to see, as soon as it shows strength, which would be this candle here, that candle close, especially with that really strong impulsive candle, tests the 50, comes back above, right? Went below the breakout level, back above the breakout level. That would be your entry point. And your stop would be, again, below the 50, below the 0.5, wherever you want to put it. That's up to you. Again, do your testing. And you'll see, though, that this one ends up holding and we go higher, right? And AGX trends up for another couple of legs or a sweep above. So that's your few different ways to enter. You see this chops up and up and up and up. Not as clean, not as impulsive, not as strong of a trend as Injective or Link was, but the principle's the same. Breakout, retest. The retest goes below, shows strength above. You get in there. You define your risk however you want to define your risk, and then ride the trend up. Of course, these are not going to work every single time. I only show examples that work because I'm trying to show you what the entries look like. But when you go through, and this is why it's so important to backtest it, you're going to notice that even using this method, you're going to have several losses, many losses, probably 30, 40, maybe even 50% losses. But your wins are going to be bigger than your losses. And that's the key point. If your wins are bigger than your losses, because you manage your risk to 1 hour, and you have a decent win rate, even around 50%, you will make money over time. So that's the false breakout method. It's really just a way to understand false breakouts, understanding that they're not a bad thing. They are part of the accumulation process. If a market wants to go higher, but everyone's trying to get long, it's going to get choppier at the breakout points. But if it is going higher and you're correct with the direction of the market, i.e. in a bull market we go up and resistance is weaker, in a bear market we go down and support is weaker, in a bull market it wants to make new highs, in a bear market it wants to make new lows, then you can use something simple like your 50 EMA to visualize the slope of your trend and get your entry points then. You'll notice as well that on these false breakouts, 1 and 2, right? 1 and then the second one. In neither of them was there trend support, meaning the 50 EMA was not trending up strongly. It was sideways flat, slightly inclining. And of course, we didn't have any strength here to reclaim. But by the time it did, you had a big impulsive breakout, which is important because that does pull the trend up. That gives you the signal that the trend is going up. You don't have to FOMO into those breakouts. Wait for the retest. Wait for it to come back below, show strength above, and then you can get in. And if you go to a lower time frame again, you can get even better entries, but that's for you to do whenever you're doing your testing. So, that's it. That's the false breakout method, which can be a useful entry trigger for swing trading. GM.